Hi everyone, welcome back to Atlas Crossings. Now, have you been thinking about investing in the stock market, or maybe you're already investing and looking to brush up your skills or get a bit more knowledge about investing? Then it's quite important that you understand the fundamentals of investing. It's quite crucial for success within the stock market. So I suggest you grab your pen, grab your paper, your notepad, and jot things down as we look through the stock market in practical terms. So if you invested £10,000 10 years ago, what would your investment be today? But before we go into talking about your investment in the stock market, let us provide some basic understanding of investing. Investing in the stock market means that you're buying some shares, you're buying stocks, and getting a percentage ownership of a company. Now, different ways you can receive income or you can make money from the stock market is by investing in stocks that generate dividends or investing in stocks that grow or appreciate in value. Your investment experiencing a capital gain or a capital appreciation. And of course, we've talked about investment in the previous video, so I suggest you go back and watch that video where we talked about investing. I'll put that link in the description. But investing in broad terms is basically putting some of the money you've saved or some of the money you have into different assets. And in this case, you can put your money in the stock market and essentially get your money to work for you. The money you invest, you expect that money to grow. So if you invest £10,000 today, if you invest £1,000 today, you expect that after a while, after some time, your investment will grow. You should possibly be receiving, steady income through dividends, if that's the case, or if that's what your investment objective is. Or at the end of the day, your investment would have grown in value from £1,000 to maybe £2,000, from $10,000 maybe to 15, or even less or more. So your investment, you expect your investment to grow in value, or expect your investments to generate steady income for you, depending on what your investment objectives are. You can, of course, go for investment that generates both income and value appreciation. One key strategy to investing is long-term investment strategy. You can engage in a passive investment strategy where you essentially buy and hold. In that case, you can invest in an index, or you can look for top performing securities and investing in anticipation that would help to grow your wealth. Now, if you take a look at this chart, which tracks the S&P 500, you can see the performance over a 10-year period. Now, the S&P 500 tracks the 500 largest companies based on market capitalization in the US. And if you look at this chart, you can see based on performance, different fluctuations over time. There has been, some dip, and there has also been significant growth in value. But what we see overall is a growth trajectory for investments that have been held for a very long time. So this is also, advocating for a long-term strategy, a passive investment strategy where you buy and hold for a longer period of time. And if we see this investment, or if we see the S&P 500 over a 10-year period, you see that it has maintained growth despite fluctuations here and there. We also see a significant dip sometime in 2020, and that we would say is as a result of COVID, but that's where you see a significant dip in the value of the S&P 500. But overall, what we see is a growth over a long-term period. For investors that have invested in the S&P 500 in 2014, for example, over a 10-year period, would have experienced substantial growth. Let's see what that data could possibly be if we invested $10,000 10 years ago. Now, what the data shows is if we invested $10,000 in February 2014 and we sold our our holdings or sold our position in January 2024, we would have generated an annualized return of about 10.3%, which would mean that our investment would have grown from $10,000 to $26,429 dollars in January 2024. So our investment would have grown by over $16,000. But essentially, there are securities on the S&P 500 that generate income for our investments, meaning if we reinvested all of the dividends we received over that 10-year period, we essentially would have received a higher return. This means that we would have received an annualized return of about 12.3%, and our investment of $10,000 would have grown to $31,621, meaning we would have essentially had almost or more than $20,000 growth in our investment over a 10-year period in the S&P 500 with dividends reinvested. It is important that at this point that I point out that you need to take certain things into consideration. Of course, the time value of money. So if you're receiving £30,000, which is of course future of value, so to say, if you're looking into the future, is to consider how does inflation affect the value of that, the returns you receive in the future. So what's the present value, the PV value? You need to take inflation into account. So if we take inflation, if we adjust for inflation for our investment, we would, be saying that our investment would generate a lower return, which will be the real value of what our investment actually is. If we adjust for inflation, a $10,000 investment 10 years ago in the S&P 500 would generate us a little over $24,000 in real value. And so we can see how those different adjustments, whether we invest without taking into account the dividend yield, how much we receive, or if we take into account reinvesting the dividend yield, but also if we adjust for inflation, we also see a different value that we receive. But overall, looking at that historical chart, looking at the historical data, a $10,000 investment in February 2014 and all the way to January 2024, we can see what potential returns we can get with investing in this S&P 500. But of course, it's important to weigh other things like the risk-free rate of return you might have received. Meaning, if you invested in a lower risk, maybe deposit in a bank, what would you possibly get? Maybe if you bought a bond, what would you possibly get in return? And also important to note that historical information, historical data does not guarantee and is not an indication of what you will receive in the future. We're only using a back test kind of scenario where we're looking at, where we're looking at historical data to say if we invested this, 10 years ago, what would we have received in our investment? What is the likely return we would have received in our investment? But of course, that's not a guarantee, and that's not an indication that that is what's going to happen in the future. But it does provide some insights for us to see what could possibly be the case if we start today and think about investing or what we can do as an alternative to grow our wealth. Now let's explore individual stocks. Let's look at Amazon. Let's look at Tesla. Amazon, being one of the biggest, or being actually the biggest retail store, seems to be a good place to look at. Again, we see an indication here of holding stocks for a long term, how that can be beneficial. There have been fluctuations, but overall, a long-term buy and hold strategy would have generated substantial returns for an investor over the last 10 years. Tesla's stock has been on a roller coaster ride over the past 5 years, experiencing dramatic swings in prices, as we can see. However, despite this volatility and the dip in prices and loss of valuations at different points in time, Tesla's long-term growth story has attracted quite a lot of investors. A lot of investors seeking exposure to future of transportation. As we know, Tesla leads in the EV market, and that market still has great potential with some countries putting a ban on diesel. We're going to see a significant move to EV cars in the nearest future, and Tesla leads in that market already. Now, before we go, just remember that investing in the stock market carries a level of risk, and there could be cases where investing in different securities in the stock market can expose investors to more risk than other securities will possibly expose the investor to. It's also important to take into account that there are several economic events that could happen that could significantly reduce the value of your investment. It's also important to think about the idea that when you put different securities into a portfolio, they're likely to react differently from when you hold them individually or when you add or mix them up in different ways and in different values and in different weightings. Being overweight or being underweight in certain securities within a portfolio can change the overall risk and the overall return that you might be able to receive on your investment. So it's quite important to think about, this. So this is not enough. This video is not enough, but it provides you fundamental knowledge as to what that investing is. And like I said, we've done a previous video on investing. So be careful when you invest. Speak to a financial advisor, a professional financial advisor when you try to invest, and do engage in more research. But there are quite a lot of resources out there that can help you to begin to invest. So I wish you the best in your investment journey. Don't forget to continue to show up, and see you next time.